Welcome back to tonight's Shares edition of Your Money, Your Call. If you have a question from our expert panel, Roger Montgomery from rogermontgomery.com and Josh Turlig from wisehour.com. 1300 30 34 35 is the number to dial. I'd like to take you to an email that we've received from Sean in Manjimup. Hope I've got that right. Okay, it's about two biggies, RIO and BHP. It says they've pulled back in the last 2 to 3 trading sessions. Are they now considered fair value? You reckon, Roger?
BHP is the better business in terms of quality. Both of them are expensive, so I concur absolutely with Josh. Even on a valuation basis, where I put in very optimistic prices for commodities, they seem expensive. Having said that, these things are proxies for the commodities, so if commodities rally, these things will just follow.
Okay, we're going to go to Gary from the Sunshine Coast. Hi, Gary. Thanks for joining us on Your Money, Your Call tonight.
Yeah, hi, how are you?
Hi, good, thanks.
Yeah, I had a question for Roger regarding Transfield infrastructure and Transfield services.
Look, I do know Transfield. I know it well enough to know that I wouldn't buy it at these prices, simply because it is expensive. It's overpaid for acquisitions in the past, and I don't like businesses that do that, and so it's not one that I've ever owned, and it'd have to be at a very, very steep discount to my intrinsic value for it in order for me to be interested.
Sam from Nord's Wharf, I believe, is our next caller. Hi, Sam.
Hi, Nina. How are you?
I'm good. Where's Nord's Wharf?
It's up at Lake Macquarie here.
Oh, beautiful.
Very nice part of the world.
Yes.
What's your
We just
question?
moved up 4 months ago. My question to the panel is, I hold some Pacific brand shares.
Okay.
Considering what happened today, I'm actually thinking maybe of buying some more. What do the panel think about that?
All right, well, let's see what Pacific Brands is trading at today. It is sitting at $1.33, down by about, lost about 2 cents today.
That share price chart that we just saw is a testament to how easy it is to make a lot of money buying really average businesses. It is a mediocre business at best, and it has been for a very long time now. The expectation, of course, is that they're going to be more efficient, and they're outsourcing a lot more and moving manufacturing offshore, and so they're all positive things. But this stock has rallied because the market has gone up, not because it's a great business.
And has it also been fuelled too by the ongoing speculation that there's going to be some kind of, big investor coming in, and we sort of hear that rumour every couple of months?
Yeah, and people buy shares for a whole bunch of reasons that have nothing to do with the performance of the business. You can do very well speculating on those types of things, but you just need to be aware that you are speculating, you're not investing. The price for Pacific Brands is way above its valuation. Let's go to Flight Centre. Its return on equity has dropped from the sort of the high 20s, 27, 24%, 2009 return on equity of about 6%. Based on consensus analyst estimates for the future of this business, I've got the value of the business now, and everyone should pay attention to this. Look at that share price. It's up around the sort of $17, $18 mark. In fact, it's $16.97. My valuation for this year is $9.81. That's what I think it's worth. I think it's worth $10.58 in 2010 and $11.49 in 2011. So, again, these valuations do look strange, and you think, well, how come the stock market is getting it so wrong? Well, I don't know the answer to that question, but my valuation for Telstra was around $3 when it was trading at $9. My valuation for ABC Learning Centres was less than $3 when it was trading at $8. So valuations are what the business is worth. Prices are what people are willing to pay, and over long periods of time the price will follow the value. The value of this company is a lot lower than its price.
Gentlemen, we've got another caller who's been waiting patiently. It's Hal from Sydney. Hi there.
Hi, thank you for taking my call. I just wanted to ask the panel, what's your thoughts on Macquarie Group and your opinions for regarding tomorrow's annual release result?
All right, Macquarie Group are below $50 at $49.25. Of course, looking a heck of a lot better than what it did at the start of the year, but still well off the highs. Roger, what do you reckon?
Macquarie will be one of the best investment banks in the world. The people running it are some of the smartest people in this country. I have a great deal of faith in them. The model is changing at the moment, obviously, and we're seeing a lot of the satellites now moving to sort of more independent models, internalising their fees and the like. That will change the revenue for Macquarie Bank in the short term, but I suspect they'll find new ways to replace it.
Is it expensive at this price?
Yes.
Gee, I just thought you might say that. From Melbourne, our next caller. Hi, Tony. Thanks for joining us tonight.
That's okay, Nina. I've got a general question for Roger and Josh.
Sure.
I understand how you do your monetary valuation of companies, but within that valuation, do you consider how the management can perform in the future and the corporate governance of the board, etc.? And a good example may be Foster's Group, which would have a valuation, say, around $5, but with their recent management changes, you go, they're heading in the right direction from what they've released to the public. Do you consider all of that in your dollar valuation?
Yeah, the first comment that was made is he understands how I do my valuations. I suspect he must have a very small camera in my office because nobody knows how I do my valuations and I'm not sharing it with anyone. Foster's valuation's nowhere near $5. In response to the question about how do I take into account management, a change of management, those sorts of things, what I look for is a demonstrated track record. And the best way of measuring how good management are, there's two things to look at. The first one, of course, is the return on equity. And the second thing is how they allocate capital. And by that I mean, how much of the profits do they pay out as a dividend and how much do they retain? If they're generating a low rate of return on equity and they're keeping that money, well, they're doing their shareholders a disservice, and I'd give them a cross on their marks. They'd get a very low mark as management. If, however, they're able to generate high rates of return on equity, that's good management. And if they're able to redeploy capital, so reinvest capital, profits that they're earning, and then generate high rates of return on that incremental capital, they get a good mark. But let me make this last point. You can have the best management in the world, and if your boat's leaking, then it doesn't matter who's rowing it, the boat's going to sink. So it's more important the business boat you get into than the management. You know, we could have a boat with a terrible leak, and we could have the awesome foursome rowing it, and they're still not going to get to the finish line, they're going to sink.
But can bad management put an oar through a perfectly good boat and cause it to sink?
Yes, they can. That's right. It's not symmetrical. Bad management in a good company is not a good thing, but mediocre management in a great company, well, a great company is more important. Really good management in a bad company, you know, Qantas, classic example. You know, it doesn't matter who's managing that business. We had the best manager, one of the best corporate managers in the world in Jeff Dixon running that business, and yet the business performance, I would say, is mediocre at best and probably worse, despite that great management. So it's really important to look at the economics of the business as well. And the perfect look, first prize, great management and a great business.
All right, Tony, take your camera out of Roger's office, but plenty of food for thought there in his comments. We've got Joe from Wollongong who's been waiting patiently. Hi, Joe.
Oh, how you going? Thanks for taking my call.
Good, Joe.
Just got a couple of questions on two small stocks. One's Focus Minerals, which is a gold company, and the other one is a oil-producing company, Strike Oil, STX. Focus has been mentioned a few times on your show, and I've seen it going up quite steadily. And in particular today, it went against the rest of the market. I just wanted to get some feedback from Roger on his thoughts on if he knows about this Strike Focus or Strike Oil.
We're going to have to go to Josh for this one because he's a bit more of a small cap kind of guy. But Focus Minerals is right though, because I've just looked them up and they went up by, look, you know, off a very low base, admittedly, but stocks did go up today. Okay, so Josh, we've got two here, Focus Minerals and Strike Oil. Can you help us with either of those?
Don't know anything about Strike Oil, but Focus, they're a gold company, they're producing. I think they've just raised money to refurbish their plant, so they're looking to expand production, and they're also looking to expand production, refurbish the plant, so increase the capacity of the plant. So look, it's tied to the gold price. I think they've just made that announcement, so it could run a bit further. It's a trader stock at the moment, but it's got a long-term goal of, I think, about 100,000 ounces by 2011. So on that metric, I'd say, provided the gold price hovers around these levels, it's a pretty solid company.
If you've got a question, 1300 30 34 35 is the number to dial. We'll be back in just a minute with more Your Money, Your Call.